Hello, ladies and gentlemen. It's Wednesday, 1 o'clock, and as usual, we start our investment show. And I would like to start by introducing our guests. First of all, it's Shaquille Latimer, who is a hedge fund manager from Australia. Show. Jim Ead from Ead Foundation from San Diego, California. Hello, Jim. And also we have our correspondent from Washington, Bill Trezewan. Hello, how are you, Bill?
Good afternoon, everybody.
Good afternoon, everybody.
Nice time.
We're witnessing an absolutely fantastic situation, the debut of the stock by the name Snowflake.
That's right.
No, it's up 25,000% or even 55,000%, but it doesn't matter. It's up.
No, actually,
I'm joking. It's only 150%, but it doesn't matter how high it will go. Maybe it will go to $200,000 a share. Now, what you can do with the stock? Should you buy? Should you sell short? You can play it. You can just enjoy, being entertained, have a good cognac and cigar. But what else can you do with the stock? Shaquille, what's your opinion?
I won't go near anything called Snowflake, so I'll just stay out of this one, I think.
Jim, have you bought some shares?
Yes.
At what price?
110.
You bought at 110, so you're making tons of money.
Jim, what did they open at?
I'm not sure.
Because the report I read said that they were shooting for, initially they had pegged it at $75 to $85. They were then going to open at $120. So I'm curious which way they went with their opening.
Oh, I am too now. Because maybe it was not. I saw the same thing you did, but I saw from 75 to 85 to 100 to 110. So I put my bid in at 110. So Shaquille, maybe you can tell us. I might not have filled that order.
Yeah, I'm just looking it up at the moment to see.
Mm-hmm.
So yeah, keep going, and I'll come back to you. So,
Yeah, because I guess
I
Sasha.
won't bother. I'll let Shaquille do it.
Sasha and Jim, I just have a question. I mean, I've always I'm completely without any skill on this matter, so please be gentle. But for people like me that are in your audience, it seems so foreign when you're dealing with IPOs because you literally have no idea. And so what does an individual investor do when they're looking at an IPO like Snowflake?
I would say if you bought this stock, you pray, and if you sell it short, you also pray. That's what I would do.
So I'm looking at Snowflake at the moment. I have no idea whether you would have been filled or not, Jim, but it appears to be. It's currently trading at just under 260 a share.
Right.
Up 133% for the day.
Wow.
Yeah,
Wow.
of course, heavy volume and
oh, it opened at 245, so I did not get filled.
Yeah.
Oh, it opened at 245. That's amazing.
That is shocking.
Wow. So.
Well, personally, I don't touch these situations.
I don't think I can share my screen, but what's very interesting is if you actually have a look at its daily candle. So it's opened up at around the 240. Well, it's opened up at 245, as you said, Jim. It's actually dropped down at some point to 240, it's gone all the way up to $320 a share, and it's come back down to 250. It's at 245 now. So it's actually right now as we speak live, it is back to where it started.
Okay. I just had a question. Shaquille, wouldn't that, when it hit the 320 number, wouldn't that just be an indication it's dropped, that people were just cashing out and grabbing their quick money and then moving on? And Sasha, is this one of the reasons why you just don't deal with snowflakes?
Okay, Shaquille, would you like to go first?
Sorry, Sasha, go
Shaquille,
ahead.
would you like to go first?
Yeah, I'm actually just trying to bring up, I don't know if I'm even allowed to do this, but I'll do it for a second.
Okay.
So I'm just trying to bring up my second screen so everyone can see the
I
actual
can
day.
tell you my rationale.
So that's the daily candle. That's its first day of trading, courtesy of Interactive Brokers. I suppose I have to give them credit for it. And I can just go for our hourly candles, just so people can sort of see what's happened. So it's gone up for the first hour, pretty much come down for the second hour. So, yeah, look, you might be right. It might be Bill. It may well be profit taking. Look, IPOs are always a bit of a dangerous play because you just don't know what they're going to do. I actually tend to stay out of IPOs, believe it or not. I've had some success with them, but for those people that remember when Facebook first had their IPO, and Goldman Sachs and some of the other lead brokers had them at 100 times earnings, and I thought, this share price is ridiculous. Like, why would you buy that? So I actually shorted them on their IPO, which worked out quite well. And I kept saying, oh, this is so overpriced. And then I started thinking, I don't want to be short this. I just don't know what I'm doing. And it's a really good thing that I got rid of my short, because Facebook has gone up in ways that I never would have imagined. And again, because tech's just not my thing. So Snowflake, it'll probably go through the roof. Sasha might be right. It'll probably be worth $250,000 a share one day. I'm just staying out of it because it's like Google. If someone told me, 15, 20 years ago that Google was going to be, a $1 trillion company, I'd think, they're smoking something in California that's just been made legal. Like there's something going wrong.
Shaquille, do you have snow in Australia?
Apparently, allegedly. I've never seen any here, but
Okay.
apparently there's a couple of places like Thredbo and a couple of places like that. But I think it's easier for us to go across New Zealand or to come in, California, see some snow up there in California or some of the other beautiful parts of America. My personal favourite is obviously Vancouver. I love being up to
Whistler.
So.
Whistler?
Australia, they call it.
Okay, for those people who don't have snow, they have now snowflakes. So.
Yeah. And I would like to tell you why I made my order, which did not fulfill, because their IPO price was 120, and I had thought 110 was going to be the outside, which is where I put my bid. But then they started trading at 245. So this is a cloud software company, and tech is my thing. So I knew about it, and I also knew that. It's based in San Mateo, which I live in San Mateo County. So, I was on top of this for those reasons. And also Warren Buffett put in like 300 million or something. And the CEO of
somebody else, yeah.
The CEO of, what is the one that knocked out mobile from the S&P?
Salesforce.
Salesforce. The Salesforce CEO put in a $250 million. So I thought
you're in a good company then.
I thought I was in good company, yes. And so unfortunately, I did not prepare for a $245 opening price.
Jim, would you be curious to find out what price per share Warren Buffett and Salesforce CEO paid for this stock?
I don't have that information at my fingertips.
I think it's crucial information, because I don't think that they paid $120 a share. I think that they would pay more likely 15, maybe maximum $20 per share. So this is a different story. And now,
I think it depends, Sasha, on whether they went in at a pre-IPO stage, or actually whether or not they might be foundation shareholders. So those are the people that come in well before an IPO is even contemplated in the company. And of course, they get the share price at relatively low prices. The people that found the company and first start the company and put their sweat equity in, apparently it you know, they're not going to really pay anything if you look at it that way, because it's only sweat equity, and that's how a lot of people can make some money. Can I just say something very quickly though, just for our audience from last week? There's a couple of comments that were made. I want to say to people, there isn't actually a right or wrong answer when it comes to the markets. So Jim talks a lot about some tech companies. He obviously understands tech, and I'll say it's no, I'm not sort of embarrassed by it. Jim is probably well more versed in techs than I am. I talk a lot about how for somebody my age, I should really know techs a lot better, but I don't. It's not my thing. And that's the thing I would say to people who are watching us and going, oh, what do we do? I would say what you should be doing is focusing on the things that you're really good at. There's another area that I would love to be really great at, which is pharmaceuticals. I would love to know that. I've got family that are in medicine. It's something that I'm very interested in. But I tend not to play the pharmaceutical IPOs or a pharmaceutical company that's coming up for FDA approval solely because I really don't understand the intricacies of that market. But if you happen to be, you know, a specialist in that, then stick to that. You know, it's very easy to stick to the things that you know and make some money out of that, as opposed to trying to do a whole heap of other things.
Yeah, Shaquille, I just can't second that enough. You know, someone that worked for Time Warner asked me about stocks because he had seen my investment track record, and I said, stick with what you know. And he knew Time Warner, so that may not have been perfect advice for him. But you know, if you don't know what you're doing, don't get involved.
But if you're the entertainment. If you're in the entertainment business, then stick to the entertainment business, right? And stuff I talk about a lot is relative difference. So, you know, if you're in the airline, if you really understand aviation, you might be thinking, why on earth would I buy aviation stock right now? Well, it might be because you think that American Airlines is going to outperform or underperform Delta or United or who's the other one you've got? You know, some of the others that you've got over there, or some of the international airlines. You know, there's always ways that you can play them against each other. For me, I actually thought I was going to take the lazy, easy way out when I was younger. So I went for all the market neutral and direction neutral strategies, which puts me into a lot more things now. So I've got to do a lot more work. But, you know, as I said, you know, it's about what you know and learning how to do things. So,
yeah. And tech just happens to have been a very good sector to be involved in. You know, I have shares of Microsoft, Amazon, and Google. Amazon, I didn't really think of as a technical stock, so I didn't really have very much involved in Amazon, but I did have a lot of Microsoft, and so that's been paying off. You know, just being focused on the tech world, because even though some stocks have been getting hammered, the tech companies have just been getting bigger and bigger and bigger.
Yeah, I think Microsoft is far the best of all those you mentioned, because it's a very stable stock. There is a risk, but very limited compared to others, like, for example, NVIDIA and so on. Microsoft obviously is a king. It's good. Okay, Bill, please.
Oh, yes, Sasha, didn't NVIDIA just go through a merger? And I forget the company they merged with. Jim, maybe you can help me out. NVIDIA struck a deal, and I think it was
right.
Go ahead, Jim. You may know more.
I did not. All I saw was the headline. I did not read the details. So you're right that there was either a merger or an acquisition. I'm not sure which.
I think
it was just wait. It's just an announcement. There was no deal consumed by far. It needs regulatory approvals, and in fact, the stock went big time up. It was same day it went down, and it's even more down today. So it's, you know what, this is something what I would qualify as a noise. There's a lot of companies, they're issuing all kind of noises, and based on the noises, stock can move up and down, but it's insignificant. And stock tells you exactly that story. If you follow the stock of NVIDIA, you can see it right away. It's a very good company, but it doesn't pay any significant dividends.
Right.
It's a highly risky company, and you have to watch the stock almost on a daily basis. I own a few shares, a few hundred shares of NVIDIA, and I sold covered calls with a strike price of 505. And believe it or not, they're expiring on September 25, which is just slightly over 1 week. Yet they command incredible premium. Even today, for example, I'll tell you right away, if you'd like to know, is the stock is now $507.25. 505, which is $2 below the price. They are $18.25. Can you imagine something like that? Do you see what's a premium there? 18 minus 2, 60, $16.25 is just a time premium, and we're talking about a few days before expiration.
Wow.
Yeah, that's what generally I'm attracted to this situation, simply because of the huge premiums, although I do understand the risk. Now, what is my risk? I got paid $20 for this call. So if the stock will go down from 505, $20, which will be 485, I'm still not losing any money. So the stock is 507, and in the next few days it has to go to 485, which is a significant move of what we are talking about, like 5%. And I'm still not losing money. Any outcome above 485, I'm making money. If it'll go below, I will end up exercised. I will get stock. My price will be 485, and from there, that point on, stock may recover. I may sell further covered calls. Premiums are really good, and we'll see what happens. That's my strategy. On the other hand, if stock will go, if it will be next Friday above 505, then the $20 premium for each stock, and $20 we are talking about because it's multiplied by 100, so it's about $2,000 for each call that is sold. We are talking about a very serious premium, and just the time expiration in a few days. And if I would choose to sell further calls, like January calls, the premium would be astronomical. But I'm not prepared to hold on to NVIDIA that long. That's why I'm selling rather shorter option expirations on NVIDIA. What do you think, Shaquille, about this strategy?
Sorry, I couldn't help myself. I put a trade on snow. I haven't told you whether I bought or something. I couldn't help myself. I was watching it and thought, I've got to get some action here. So
yeah, it's very unusual. When you're watching this movement, I hardly contain myself. It's just not part of my strategy, and it's like, okay, I'd rather if there would be a casino, I would rather put some bets on the blackjack.
Shaquille, I can just say this. I appreciate you for being you, and there was a conversation we had another time when I said that you are an unrepentant capitalist, and
that's right.
And I celebrate you, because you are now in play with a company called Snowflake. Just think about it.
Yeah, that's it.
Ever been?
I can see me doing it. I'm a natural for Snowflake, but Shaquille?
Jim did not wear a colorful shirt today. I decided I'd wear blue to keep him happy. You rock up in a red tie. So I thought, look, if California's giving tips away, I'll get involved. I'll get involved.
You guys, I agree generally speaking with your philosophies about IPOs. But again, if you're in the know, if you know something about this, that's when you play. And so I did know something about this, and I still got it wrong because it opened way higher than I expected it to. And so, I'm not playing. But I only had 20,000 in the game anyways. It's no big deal to me, one way or the other. But, this is where the hype was. This is where big money was being put in by big players.
Right.
So to me, I wanted part of the action.
Right.
Yeah, and look, I'll say that to people as well. Like, if you want to be involved in something like this, just like I am at the moment, I'm just having a bit of a play. But maybe my version of having a bit of a play might be a little bit different to most people, but that's okay. One of the things that I will sometimes do, and I was contemplating doing it with that, that's why I was sort of distracted, was that instead of actually cashing out once I've made a profit, I'll sometimes just take my original capital off the table.
Right.
So something that I'd like to own, and if I've bought, $10,000 worth of shares, and it's now worth $11,000, I might just sell my like $10,000 worth of shares. So that $1,000 that's profit, instead of cashing it in cash, I just leave it sit there and see what happens to the company. And
I do that at blackjack, don't you, Sasha?
Yeah, that's very, very smart strategy. Of course, you have to sometimes take profit. You cannot see it forever in a stock or in options, even more so. In my situation, actually, because I'm selling options, I'm not buying them, I'm selling options, whether it's covered or uncovered, but still. Well, even uncovered, first of all, I never sell uncovered calls because potentially your loss is unlimited. So therefore, it's, you can do it and most likely you will make money, but it's too complicated and I don't know how should I put it. It's against my religion to sell uncovered calls, okay? If anybody would agree with me. However, selling uncovered puts is a different story. For example, if I like a stock, let's say I like Microsoft. Microsoft is trading, say, at 210, right? And I think 210 is a good price that I would like to buy it. I would sell 210 uncovered puts, which if I will be exercised, so I will get, say, $12 for each put. So essentially my price of stock, instead of 210, is only 198. So if you like Microsoft at 110, you might even more like so at 198, right? So in this case, now if stock will move higher, then of course you keep all the money, all the premiums that you were paid. However, you are leaving on the table all upside. Let's just Microsoft is going to 220. And you're not there, you're not making so much money because only on those puts that you sold. So while you're selling, let's say I sold 10 puts, for example, right? I would use some of the money to buy 4 or 5 calls.
Mm-hmm.
So this strategy, okay, because it didn't cost me really any money because I used profits from the premiums that I got from the puts. So I would use some of it, not exactly. If I sold 10 puts, I would not buy 10 calls, but I would buy 4 or 5 calls just to see the upside is still there. And Shaquille, what do you think about this strategy? Does it make sense?
Look, I'm always reluctant to we talk about things like covered calls and stuff like that. I know the premiums can be quite juicy, but sometimes they're juicy because there's an extra risk that's being taken on that you may not see.
Volatility, time.
If it works for you, go for it. But yeah, I'm always a little bit shy of doing that, just because I think that as an individual investor, you actually have some advantages in that you can just come in and out of certain shares, and you can just focus in on 2 or 3 shares or stuff like that. But as somebody like myself, it's very difficult for me to trade even my own account much differently to how I trade institutionally, because it changes how you look at the markets. And so institutionally, I'm always going to have hundreds of positions on at the same time. And so when I'm doing something personally, it'd be pretty rare that I've got less than 30 or 40, share positions and a few options positions, and quite a lot of the currency cross pairs and things like that. I'll have all of them happening at the same time in my account. So yeah, that's my thing. But again, I don't really suggest that people try to trade like me, because that's like.
So, it's kind of funny.
Kids, don't do this at home. He is a professional.
Leave this to the professionals. This is under certain conditions.
Yeah. Hey, Sasha, I've got a question for you that I've been meaning to ask you. What do you think of these cryptocurrencies? Because Shaquille just mentioned the currency exchanges and things like that. So I'll let you respond, and then Shaquille wants to say something too.
Well, my response will be a very short one. I've never touched them and have no plans. That's about it. Shaquille, do you have any other suggestion?
Well, I think everyone knows how I feel about the cryptos. But again, look, I remember.
I don't, and there are millions of us around the world that don't, Jack. We'd love to hear.
I don't know how I feel about them. No, look, the thing is, I remember when I first heard about Bitcoin, and there was a guy at the office. He's like, "Hey, we should buy some of these. They're only like 20 cents or something." I'm like, "I'm not buying those." He's like, "Well, just put 10 grand or something in." I was like, "No, I'm not doing that." Well, more fool me, right? That's another one I missed. But look, the overwhelming problem that I have with cryptos, and I think I've said this a couple of Mondays ago, is I actually don't see what problem they're solving, and so it's kind of a pointless, to me, just the way I view it. It's kind of a pointless exercise. And one of the things that this is actually said in one of the annual statements, I think it was either last year or the year before. Again, don't try reading that at home. It's so boring. Like, trust me, you don't want to read Fed releases. You don't want to read Bank of International Settlements releases. But if you do want to talk to yourself and you want to read it, they actually make mention of cryptos there as well. I think, well, blockchain technology certainly appears to have some uses. Cryptos can be great for small micro payments going to regions of the world that are, perhaps a little bit poorer and don't have, very good banking infrastructure, and companies like Western Union might be a little bit too expensive. But yeah, I mean, for the most part, I don't really see an advantage there. And one of the things that we talked about before was the good thing about having a crypto is that it takes away the control of the currency from a central bank. Well, if that is the theory that you're going to go with, why not just get rid of the central bank and let the money supply be determined by the open market, as some economists like Milton Friedman suggested? Jim, you have a question?
Because that was my thinking, was you get away from the central banks. Hooray. Let's get rid of them. I think the appeal to cryptos for me is just that. It's not managed. It's free market.
So what I'd say there, Jim, though, is first of all, I don't actually agree that the central bank shouldn't be around. However, I'm a banker, so I'm going to defend. Now, I've defended Goldman Sachs a couple of weeks ago. Now I'm defending the Fed. It's brilliant. Yeah.
Shame on you.
This is the difference between, in my opinion, between crypto and a company like Microsoft or any other. Buying shares of Microsoft, you understand intrinsic value, you understand where the profits coming, and what the company really going to do in the future, and you make some assumptions or whatever. With the crypto, it's something that you can't really understand what's the intrinsic value of the crypto, whether it's $100 or 1,000 or 20,000 or $100,000. It's very difficult to make any assumptions. I wouldn't tell you a story.
The crypto guys would argue the same thing about actual physical currency, though, as well. Like, if you hold up a $50 bill, what's that actually worth intrinsically? So, fiat currency does get its value from the fact that by law, because it's by fiat, by law, it can be used to extinguish a debt. And ultimately, given that most money is created as debt by the Fed or by commercial banks, the fact of the matter is that they can pay their taxes and their obligations to the government using physical currency. And so there is some inbuilt protection as to that theoretically.
Well, I mean, with $50, you can buy so many hamburgers, for example, or you can buy so many loaves of breads or so on. Now, with the crypto, it's less, should I put it mildly, less clear, actually, what you can do with crypto and so on. But I want to tell you, to illustrate this, I will tell you a story which I recently heard. It's about two, I hope I will not offend anybody, two Jewish friends met. And one of them said, I just got a container worth of cans of sardines, and each can cost only 15 cents. So the other one thought for a while and said, oh, you know what? I want to buy it from you, and I will pay you 17 cents per can. He says, okay, deal. So they agreed, the deal is done. They are meeting next day, and the guy said, well, I paid 17 cents. And the other one thinks that he forgo all the profits on that. And he said, you know what, I wouldn't mind to buy it back from you. He says, yeah, sure, 19 cents. He says, yeah, okay, I'll pay you 19 cents. So he paid 19 cents. He acquired it back. So the other guys think, oh, why did I do that? They're really, I mean, such a good price. So next time he bought it back now for 22 cents. So then the first guy bought it back at 25 cents. So finally, that second guy bought it at 28 cents. Now they met a couple of days later, and the guy who bought it at 28 cents, he said, you know what? I opened one can. They're horrible. I can't eat them. They're horrible sardines. The first guy said, they are for trading, not for eating. See, so this is a crypto, in my opinion, is very easily classifies into something that you trade and you can make or lose some money. But what else you can do with that? You can't eat it. So to me, there's no value.
Okay, well, and this is just a question, Shaquille and Sasha. Is that the kind of and now Jim, is that the kind of psychology that happens with these IPOs over like the first week, that it's more of a feeding frenzy and it ratchets it up and then people all cash out and then they're left with bad sardines?
Look, I think it can be. Sorry, is that to me or Jim?
Okay, you go. You go. Shaquille.
Whatever.
Go.
Look, I think it can be, but I mean, it's hard to determine what a person's going to do. For the audience, I just very quickly bought some shares in Snow. I sold them out, made a $10 profit. It's actually moved another $15 away from where I sold it. Now I can sit here and go, oh, I could have made an extra $15, but I was just playing around. You know, I think that that's the kind of thing that some people will just go in and have a bit of a play just so they can say they were involved, right? Other people, like some of the last one that I did actually wasn't an IPO, but it was a capital raise for a company here in Australia, and I bought the shares at 3 cents a share. When that share price got up to 10 cents a share, I got rid of about a third of my shares, which gave me my money back. When it got to 20 cents a share, I got rid of another bit, which doubled my money. I left the rest sit there, and ultimately I got out at about 30 cents, which thank goodness I did, because the thing fell down to almost nothing. But when I got out at 30 cents, I didn't actually get out of everything. I did leave a little bit on the table, which I never would have sold. It would have just sat there and, you know, until it either went bankrupt or it got taken over or something happened, because I'm no longer worried about that. It's just a part of my portfolio. It's just going to sit there. I'm never going to look at it again. And so I think there's a lot of foundation members, you know, certainly Mark Zuckerberg and, you know, some of the other founders of Facebook, they certainly did cash out some of their shares along the way, because for a lot of people that have been involved in companies, and tech's a very good example of this, a lot of the original people that are involved in tech, they don't have a lot of money themselves, and they've borrowed everything. They've been living in mum's basement floor for the last 5 years, telling mum that, hey, I've got this really great idea, and finally something actually comes off, and this is their opportunity to kind of cash out a bit, get some money there, and then the rest of their shares they can hold, because don't forget they can borrow against their assets. Mm-hmm. So that means they're not having to pay tax. They just borrow against, you know, the intrinsic value of the shares. And so I think that's what you see a lot of. I think you see a lot of that sort of short-term profit taking. Things will stabilize and then things will go up. But look, sometimes you see an IPO and it just goes up and up and up and up and up. And there's so much demand for that IPO that even after the original people start cashing out, it just keeps going up anyway. That's very hard to see. And of course, and sometimes it'll happen where it just drops and it just keeps dropping. So,
wow. From the psychological aspect of it, because, you know, I am from California, you know, you have to understand what Sasha brought up earlier, is that these guys like Berkshire Hathaway and Salesforce, they're getting in at a different price than you're ever going to get in on. So, you know, they're what they consider profit is not what you're going to consider profit, because you're going to get in at a more expensive level. So when you start to see, you know, they're going to make more money than you are, regardless of how high it goes. And when you sell, that's up to you, the individual. They're going to take out. They're not taking out all the money they put in, but they're going to take out some, because they obviously, you know, made a lot of money. They probably covering what they spent, and then they're playing with house money. They're happy, so they're not taking all of their money off the table. So some of that is still invested, and you've got all the what I call the lemmings piling on afterwards, that are driving it up to a place where it doesn't belong, probably, and beyond. So some guys like me will try to get in, not where their investors, the smart money is, but before the lemmings get in, or as early as possible, and then the lemmings will drive the stock up. And I intended to sell. And yeah, I pay a lot of taxes in California, so I'm not going to sell minus the taxes until it's meaningless. I'm going to at least double my money so that I can pay my taxes on it, and then still have some cash, which I'll invest in something else. But my idea behind an IPO, and again, I knew what was going on with this IPO, so I knew it's cloud computing, it's cloud software.
Right.
So this is going to be around. This is not going to go bankrupt tomorrow.
Yeah, but they're competing against, I think it's Oracle, and who's the other big cloud? Well, who's the other big cloud one?
A lot of people are in the cloud. A lot of people own cloud software. Apple's in it.
Yeah.
Amazon.
Amazon is the other big one that I was thinking.
Amazon, absolutely. So, but these guys are going to be managing them. And so they're going to be helping them manage all the cloud stuff. So this is a good company fundamentally from my point of view, but that don't take that as advice, because it isn't. It's just my perspective on it. And what I think is going to happen is this will stabilize at some point at a higher level than it currently is trading. And I wouldn't have sold at 245, for example. If I got in at 110, I wouldn't have sold at 245.
I got in at 235 and just sold out 247 because I put a relatively small position on. I'm just mucking around because I was on the show and thought, yeah, I'll get in that real quick. And to make $10 a share in however long that took, 7 minutes or 10 minutes or whatever, I'll take it. But look, I mean, I would have. I mean, that's like betting at the casino or something for me. That was just a bit of a play.
I so dig it.
But what I'll just very quickly say, just in relation to cloud, we probably should mention that IBM also has cloud technology. We should really mention them to be.
But we're international broadcast media. We're not IBM.
Yeah, I know that. But I'm just saying, to be fair, we should also mention them.
Yeah.
But
anybody who's big is into cloud computing. Yeah.
And it's been very interesting because if you look at a group like mine, we trade the markets. We started as five guys, sitting around with a couple of laptops and a couple of TV screens with our laptops plugged into, trying to do some trading strategies ourselves. That was similar to what we did at banks or financial institutions that we previously worked at.
Couple of carafes of wine.
Glass of wine. It depended on whether we won or not that day. Yeah. But that was how we sort of started off in finance and sort of building up our own gig basically. And today, it wasn't that long ago that we started. I'm 36, so it wasn't that long ago that we were really sort of trying to start this process. And today, the kinds of technologies that we have access to is incredible because of cloud-based stuff, software as a service. Those types of things make such a big difference because for a few $100s a month, I can get access to the latest, most up-to-date things that before I'd be spending tens of thousands of dollars a year upgrading hardware and upgrading software and upgrading all this stuff. So I definitely see a future in it, but it is still the scary internet. What the hell? I can't see it. I can't touch it. So
yeah,
I wouldn't mind if and when snowflakes would have options. I may be looking into it because there will be a huge volatility. The options will be priced probably at astronomical level, and that would make interesting. See, but right now there are no options. So basically, yeah, you can do quick in and out. It's a right strategy. I think Shaquille.
I'd seriously doubt that they wouldn't have options. But just remember, even a company like Facebook, when it's on the day of its IPO, it was just the shares, and I think it was. You might know more than I did there, Jim. I think.
It opened to 23 and went down to 17 in a matter of 2 weeks.
Yeah, it was. Yes, it was actually below its opening price, and it was looking.
Yeah, it was.
It was looking pretty bad, grisly.
Well, I was happy because I'd shorted it on its IPO day, but that's when I changed my mind and decided to buy it back. But yeah, but for options is what you were talking about. I think normally it's 2 or 3 weeks after listing or a month or something after listing, options become available. So
absolutely. Yeah, it's we're living in a very interesting time when there are so many investment ideas. There are very speculative, there are conservatives, there are, but you know what? It came to my mind one idea, even with options, what I'm doing quite a bit. It's still the selection of stocks. It's still a very important thing because even when you're doing options, but not on all companies you are doing options, you have to select really a very strong companies fundamentally, and preferably not in just one sector, because the tech sector, I think there is a little bit outflow of money from tech sector right now. Maybe it's not going to happen for a long time, but at least for last few days, even today, there is still outflow of money from high-tech stocks. So you should have some maybe food stock. And my preference always been Costco, and then you should have probably some maybe pharmaceutical companies and those some very good companies like ABBV, AbbVie. It's paying huge dividends, and no, I mentioned several times Altria, which is paying 8% dividends. So you have to be looking at different sectors, not always high tech, simply because there are times when there are outflow of capital. So if you sold, like for example in Nvidia, I sold covered call, and what I'm looking today is that price of the gold dropping really like a rock down, which is good for me. But I still have a lot of premium is still there, so I'm not going to buy it back. I will just let it expire worthless. Hopefully that's the case. Yes, Bill, please.
Sasha, Jim, Shaquille, and I'll direct it to Jim, and then we'll go Shaquille and then Sasha, because Sasha, you'll give us a big idea. And that is that today the U.S. Federal Reserve is going to be announcing what its policy is with regard to its benchmark interest rates. Now, most people expect it to stay at or near zero. Is this going to have an effect on your strategies as you move forward, given all the other volatility that's going on in the U.S.? Jim?
Well, so I'll give you the small picture because we're going to build to the big picture with Sasha. I think that the interest rates will remain essentially unchanged and will essentially have no impact on my investment portfolio or how I go about trading. Because I'll quote Sasha here and say this is a trader's market. All the other rules that we live by for decades are out the window, and you have to pounce when the opportunity is there and get out before it's too late. So you have to be very alert and active. Like Shaquille just made 10 grand in a minute. You know?
I didn't say how many I bought.
He didn't say how much he made. He just said it was $10 a share. We didn't know how many shares.
Oh yeah. Okay. So he made 100 grand. Wow.
Now the audience knows that I just just had a gamble with 250 grand. Thank you for that, Jim.
I'm sorry. I didn't mean to say a number. I just meant an amazing amount of money in a short amount of time. And
no, with that, we will go to Shaquille for a denial. Shaquille.
Yeah. No, the idea is that's how you have to trade in this market.
Mm-hmm.
You have to be able to get in, get out. You have to be able to play it. You have to do options like Sasha does. The old rules of investing and buying and holding might not be the reality today. And interest rates are not really on my radar right now, unless they go dramatically up or dramatically down.
Where they can go down?
Yeah, well, there are negative interest rates in existence right now.
In the United States.
In Europe.
In Europe, yes. Agreed.
Yes.
Okay, Shaquille, you please, your view.
Well, look, it's definitely a trader's market for sure. And that's why, for my personal account, I do a lot of pairs trading strategies, which I haven't really used for a while. They're sort of the strategies that are sort of on the shelf and there's cobwebs on them and you sort of pull them out and dust the cobwebs off and say, right, let's use some of these old strategies because it's just, there's a lot of volatility and again, the relative value stuff I think works quite well for me at the moment anyway. In relation to interest rates in and of themselves, so I think that the US will, this is just my personal opinion, I don't think the US will ever go negative for the very reason that once they've gone negative, they can never again say, we never had negative interest rates.
Oh, wow.
There's a certain level of strength.
Okay.
There's a certain level of strength that they've got over the Europeans because the Europeans have allowed that to happen. But there is a trick that the United States likes to pull, as do a lot of other countries like Australia, who I don't think will ever go negative. And the trick is that they increase inflation. So on a net basis, if you put your money into the bank and you get interest on it, or from an institutional perspective where you are only getting the effective Fed funds rate on your money, once you account for inflation, you're actually going backwards. And so that's how they effectively turn it negative without turning it negative. But remember that the theory as to why...
This isn't worth as much.
Exactly. You can cut one corner off it.
So we're talking about cryptos, but, this can fluctuate too.
That's right.
Right.
And I think that one of the things that the US has said, and I've always found this really fascinating as a trader, even when I was sort of back studying, in my younger days, was this notion that the US debt is risk-free. The US can never go bankrupt. And I thought, well, they can, can't they? I mean, any country could. Do you know what I mean? But it's highly unlikely. And one of the theories behind this is that the US can always just print more currency. And my sort of answer to that as a smart aleck at 20 is like, can't every current country, with the exception of the EU, can't every country just print more of their own currency? Isn't that how it works? So yeah, I do think that you won't. It's very unlikely you'll see a default in the US, but you could see a massive increase in inflation. We're not seeing that increase right now, but we are seeing asset prices go up. The other thing I'll just very quickly say is that's my thing. I trade interest rates. That's what I do because there's so much liquidity there. And when we trade interest rates, we trade the differential between the 2-year and the 5-year interest rates, or the 2-year and the 10-year, or the 5-year and the 30-year, or whatever it may be. Or you trade the difference between the interest rates in the United States and the interest rates in the UK or Australia or other major world economies. Okay,
Shaquille, just as a question, is that for our viewers, is that a form of arbitrage?
It's not a form of arbitrage. You'll sometimes hear, if you're watching some of the financial press like Bloomberg, you'll sometimes hear them talk about the steepening or the flattening of the yield curve. And what they're actually referring to is that, generally speaking, if you're only going to tie your money up for a year, you're going to get a lower interest rate than if you tie your money up for 10 years. So you would expect the 10 years to be a higher interest rate. And you can actually plot that on a curve. You can actually plot that on a chart. And under normal market conditions, you would expect that curve to be upward sloping, which means that your short-term interest rates are going to be lower than your longer-term interest rates. But sometimes you'll see that reverse. And actually, prior to COVID happening and during 2019 and late parts of 2018, we actually saw that happen quite a few times. And the press was going off saying, hey, is the Fed going to reverse the yield curve? Invert the curve is what they call it. Is that what the Fed's going to do? Are they really going to do that? And a lot of people said, well, that's normally an indication of the looming recession. And of course, COVID hit. And so for those of us that said, like me, yep, got it wrong again. For those of us that said this market's different, no, it wasn't. Something happened. It just wasn't what we thought. That caused there to be a lot of volatility in the market. And that's why we've seen such a rush to safety assets.
Sasha.
Yes. Well, what Shaquille is discussing, it's definitely applies to professional traders like he is, and it could very difficult to see how the individual investor can benefit from this, because very few people have abundance of capital, and we're talking about millions and millions of dollars, that they can do any meaningful swaps of different 5 years notes against 30 years bond. It's probably almost unapplicable. In very, very few cases, somebody can employ the strategy. So individual investors, they're basically operating the way they're buying some shares. For example, they believe that the shares will go higher in price. Some of them more advanced probably may sell covered calls, or maybe even before they would acquire shares, they would sell some puts to acquire those shares at a lower price. So the instruments are entirely different from those of professional traders, because professional traders even can't do this because if they're operating with billions of dollars in capital and they want to take any meaningful position, even in such liquid stocks as we are talking about, they will move the market by sheer size of their order. Because the book is very balanced. Let's see, professional money makers on stock, let's say Goldman Sachs, let's say they're trading Microsoft stock. They have supply of say maybe 100,000, even a million shares of Microsoft, and they have say $50 million worth of cash, and they're making the market depends on supply and demand. They may lower price of Microsoft share or maybe raise it up if there is more demand or so on. However, at the end of the day, they must finish with the same 100,000 or a million shares of Microsoft. Now, their cash position will be different, depends on their success of trading the stock, but they still have to have the same supply. Yes.
Yes, actually, I just have I have another question. And remember, I'm the novice here, but normally we talk about quarters, and we're looking at the fourth quarter coming up of October, November, December, and it's obviously volatile. So, I mean, for this fourth quarter, what's important that you guys are going to be looking at as investors in terms of it impacting your investment strategy? And I know you guys each have different strategies, and you work in different parts of the market, but I think our viewers might be interested in hearing. Jim, how are you looking at the fourth quarter and what your strategies are for approaching it?
Well, the fourth quarter, generally speaking, I have, say it's not an election year. It is an election year.
No, Jim, you have to say it is an election year. So no, you can't. Any other year I would play, but no, we can't now.
Okay.
We have this year. And
allow me to say what I would normally do, and then then talk about an election year. Basically, the way I play this is that investors, the big investment companies, are going to want to show a return on investment,
right?
And to their the people that have given them their money. So there is usually a trade-off of their profit-making companies. And this happens often in December. This sometimes happens in October as well, when it's an election year. So that they will they will get good returns locked in and be able to, so whatever the market does afterwards, they can say to their people who have given them their money, we gave you this good return. And so there is that component. Whenever you're talking about quarterly reports, CEOs do this all the time. So this is one of the things that you have to think about in an election year. Are they going to take the money off the table in October because it's November election, and so that they can have this quarterly report regardless? Because what if the stock market goes way down in November based on the election results? They aren't going to be holding all that money and lose it all and then report to the people that gave them the money in the first place, oh, we had a terrible quarter. No, they'll probably lock that money in right before the election. And then whatever happens in the election, if it goes way down, if it goes up, it stays the same, then they'll put the money back in. This isn't all their money. It's not an all or nothing thing, but there will be some that they can report a good quarterly report. And because it's an election year, you might see that happen in October rather than December.
Okay, Shaquille, that's Jim's October surprise. How are you looking at this fourth quarter?
Yeah, look, so I'll have to talk about what I do personally here as opposed to what I do professionally, just because professionally, I'm market neutral, so I don't need to do too much. And that's specifically why we're market neutral, so that we can withstand anything that really happens to the markets. It doesn't really make too much of a difference. We're not going to lose too much. And that's because we're a global macro absolute return fund. So I cannot go back to my client base and say, coronavirus hit, so therefore we're down 20% on the account. I can't do that. But just from a personal perspective, look, I think that just leaving the election aside for a moment, because I think there's actually something that's bigger than the election right now. And that's the coronavirus and the economic impacts of that, because that's been building up for a much longer period of time. So under a normal situation where you're coming into an election, if you call this a normal election, I don't know, but if you look at the election outcome, you look at, okay, what are the two possibilities? The Democrats will win or the Republicans will win, right? So you look at that and you try to make an assessment as to what you think the economic impact of either side winning the election would be, and what impact that'll have on the markets themselves, which is not the economy, Jim, I know, but that's something that you look at as an investor. This time around, it's very interesting because you'll often look at quarterly earnings reports, but we're going to be expecting large sectors of the markets to not have very good quarterlies, or even very good returns for this year, actually, this calendar year, with the notable exception of tech. So tech's done very well, and we've seen massive increases in the share price of a lot of tech companies. There is a type of thing, I don't want to confuse the audience, there's a type of thing called sector rotation where people will actually move from one sector, or the institutional money will move from one sector of the economy. So, for example, they might move from the tourist type things across to a different sector, and they might move to more safe assets like utility companies, with the exception of PG&E in California. Utility companies generally are pretty safe and stable. Obviously, PG&E has had some issues over there, but most other utility companies are pretty safe, pretty stable, predictable revenue, that sort of stuff. So, you will see sector rotation. I think we've seen a lot of sector rotation into tech. What I'd be looking at is, are these companies that are still around, are these companies, going to be profitable? Do they still have the potential to bounce back once coronavirus is finished? So, for example, Disney World, I assume that the theme parks are all closed. I'm assuming, I don't know, but you would think that once this sort of ends, once coronavirus ends, people are going to want to take their kids to Disneyland. They're going to want to take their kids to the cinemas. They're going to do all those sorts of things. So at depressed prices, might be a good time to get in.
Wow. Okay, Sasha, you're here to kind of make sense of.
Okay, first of all, Bill, before fourth quarter, there is such thing as the third quarter. The third quarter will be reported early October. My theory also is that before election, market will struggle to keep it up to help the incumbent. Now, once election is done and it's over, and nobody knows the results of the election, obviously, but there could be contested election that will go on for months in the courts and elsewhere, and investors don't like unpredictability. So in this case, there is another reason for market to go down beside the COVID-19 issue, beside the unfavorable reports, whether it's the third quarter or fourth quarter or whatever it might be. To be practical, I will tell you, besides just talking, I'll tell you exactly what I'm doing as an individual investor, and it's not an advice, it's just a reflect of what I'm talking about, but also what I'm doing about it. Okay, here's what I'm doing. Number one, selection of stocks. Number one, dividend-paying stocks. We are talking about Altria Group. We are talking about Enbridge, utility company. It's a Canadian company which is paying very good dividends, very stable. Obviously, it's a gold. Gold has, I'm talking about company Barrick Gold. Its cost of production of 1 ounce is $900. And the gold is now hovering around $2,000 per ounce. And very likely it will move higher. I can't predict exactly when, but the direction to me is obvious. It's only one way, is higher. Now I'm talking about obviously instrument which is triple bear on Russell 2000 by the name TZA. Now, I've already amassed a very significant position there, and I keep accumulating even more so, because if the market will drop, the question is when. In my opinion, there is no question that the market will go. Now, if that's the case, then anybody who has position in TZA will do extremely well. Now, to offset cost of holding this position, obviously what I'm doing, I'm selling both puts and calls. So TZA is now about 15 something, 1560. I've sold a lot of puts of $20 puts. I have expiration of January 21, but I also sold calls. The only puts is striking price 20 and calls striking price is 22. So I still have a little bit more room to make slightly more money, but I have, I'm amassing very, very significant position in that instrument, and I hope to do quite well with this, and I hope everyone who is doing this same thing probably will end up well in the situation.
Well, how could we have three different parts of the field? So if they just listen to you, Sasha, and you, Shaquille, and Jim, they should be fine because they'd make a quick. What did you make? 300 grand, Shaquille, in 10 minutes, according to.
Oh, was it only 300 grand? Oh, you
million. According to Jim. So
he's muted. He can't argue back.
Oh, look at that.
I wish it was. I wish it was 300. No, it was just 10. So,
No.
But I know that Jim will be sitting there next week going, "Oh, look, the share price tripled, and you should have hung on to that position you had."
Yeah.
Jim,
my rock boss was Tesla. I should have held on to Tesla.
Jim, sorry, I'm trying to address your comment about when everyone was telling me not to buy.
Oh.
I bought. That's a contrarian for you. What that means?
Oh, Disney. It was a private chat, Sasha, but it was we were talking about Disney, and everyone was telling me to not buy Disney because of the theme parks. And I was saying, hey, look, they have so much content to stream. Everyone was telling me not to buy, so I bought, and that's what a contrarian would do.
I see. Okay, fair enough.
So that the audience knows, we have the ability to talk to each other privately, and that's why Jim accidentally revealed how much money I'd made on that position. Just wasn't thinking that I hadn't actually said that. And Sasha's now called out Jim and said, "What was that thing about being a contrarian?"
Well, it's a very interesting discussion. I hope next week we are going to discuss what's happened in the previous week on the market and how our individual positions, or at least in my case, I'm not asking you to do the same thing, but since I've initiated this program, I think it's my obligation not only say something, but also do something and reveal what I'm doing. And I'm very pleased to do so. Thank you so much for participating. Looking forward to see you next week. Bye-bye, everybody. It was Modern Investing with Sasha, IBM TV. Thank you, and bye-bye.